All right, let's look at the data. We're talking about the 52-week low list. Now, most traders, they see this as a graveyard, a list of broken companies. But for us, we see it as a hunting ground for market anomalies. We're here to build a data-driven framework, one that helps us find stocks where that extreme selling pressure might just be coiling a spring for a really explosive move. So you look at a list like this and it just screams heavy selling pressure, right? The consensus on the street is pretty clear. Broken stocks, broken stories. Basically, they're left for dead. And look, for a lot of them, that's probably the right call. But not for all of them. So this is the critical question we have to ask ourselves. Is this just a list of losers, or is it a high-potential watch list hiding in plain sight? For us, this is ground zero. Our entire objective here is to filter out all that noise, find the signal, and pinpoint a clear divergence between what the market price is doing and what the data is actually telling us. So our mission is really precise. We want to identify stocks where the selling pressure is either fundamentally overdone or technically just exhausted. We are literally hunting for that inflection point, that spot where the data shows that bearish momentum is finally fading, and that creates a measurable divergence that we can actually act on. Okay, so to do this right, we need a very specific toolkit. Before we even think about fundamentals or the latest news cycle, we start with pure price action. The chart, you got to remember, is a raw data feed of the battle between supply and demand, and we need to know how to interpret it correctly. Every single candlestick is a data point in that battle. It shows you the open, the close, and the absolute extremes of the session. A long string of red candles in a downtrend, that shows you consistent seller dominance. Simple enough. But what we're watching for is the exact moment that data stream starts to change. And here it is, our first key signal, the doji candle. After a really punishing downtrend, this little candle signals seller exhaustion. Think about it. They tried to push the price lower, and they failed. Buyers stepped in and fought them to a draw. Now, this isn't a buy signal on its own, but it's a critical pause. It's a point of pure indecision, where momentum is right on the edge of a shift. Now we get to the hammer pattern, and this is a much stronger signal. Here, the sellers attempted to force new lows, but a massive surge of buying pressure just emphatically rejected them. This is what a potential capitulation bottom actually looks like in the data. So then, we add another layer of data on top of that, the Relative Strength Index, or RSI. When the RSI dips below 30, it signals an oversold condition. Now, that doesn't mean the stock can't go lower, but what it does suggest is that the selling momentum is pretty much exhausted, and the move is statistically overextended. So, the chart is signaling selling exhaustion. That's clear. But that really begs the question, what was driving all that intense selling in the first place? Our hypothesis is that this isn't just about fundamentals. It's about heavy institutional positioning. And that brings us to the catalyst, short interest. This is where we look beyond the chart, deep into the market's microstructure, to see just how many institutional players are betting heavily against the stock. This data can reveal a whole hidden layer of pressure that most people miss. Now, the crucial point here is that high short interest means a huge part of the market is betting on a continued decline. They've borrowed shares, sold them, and now they're sitting on this massive liability they have to cover eventually. We can even measure this with a metric called days to cover. If that number is high, it means the exit door is tiny, and any rush to cover is going to be violent. If they're wrong, that liability, it becomes rocket fuel. And this is what extreme pressure looks like in the data. Just look at these numbers. For these companies, nearly a third of their entire publicly available float is being shorted. The bearish sentiment isn't just high, it's at an extreme, totally quantifiable level. Let's just pull out this number for Eurogen Pharma, over 29%. You have to understand, this isn't some small bet. This is a crowded, institutional-level trade betting on this company's absolute failure. And you know what? Crowded trades can unwind violently. And that's what we call the coiled spring effect. When you have short interest this high, any positive catalyst, any little surge in buying forces those short sellers to cover their positions. And at that point, it's not about fundamentals anymore. It becomes a pure supply and demand shock driven by positioning and liquidity. So now, we synthesize all the data. We have the technical setup from the chart, and we have the institutional catalyst from the short interest. This is where we build the playbook, a clear, actionable framework. This is it, the Anomaly Hunter's checklist. Step 1, scan the 52-week lows. Step 2, identify those bullish reversal patterns. Step 3, confirm the setup with an oversold RSI. And the final, absolutely crucial step, verify high short interest is there to act as the fuel. It's the confluence, the combination of all 4 of these factors that creates the high probability setup we're looking for. Now, let's be totally objective here. The bull case is crystal clear, a powerful technical reversal that could be fueled by a massive short squeeze. But the bear case must be respected. These stocks are cheap for a reason, and the institutions shorting them, well, they might be right. This isn't about being certain, it's about identifying high probability setup and then managing your risk. So here are the key principles you have to take away from this. Let the data be your guide, not your emotions. Always prioritize risk management. Understand that this is an analytical framework, not a stock tip. And above all, you have to remain objective and let the data, not some narrative, dictate your decisions. And of course, I have to say it, this analysis is purely for educational purposes. The data we've talked about is just a snapshot in time. It changes constantly. You must always conduct your own due diligence. We are tracking these flows in real time. So while you analyze the next move, go ahead and check out the tools in the description. You can sign up for Public to get $20 in free assets, check out Webull for that BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, like and subscribe for more deep dive analysis. So, we've laid out the entire framework. The data's out there, and trust me, these setups happen a lot more often than you think. The real question is, can you use this playbook to spot the next one? Stay disciplined, stay liquid.